If I told you right now that I'm 22 years old and own 3 rental properties, would you believe me? That's the honest truth, and here in this video, we're going to give you guys a crash course on how to become a real estate millionaire no matter what age you are right now, and you can start today. Let's cover the basics first before we get into the actual strategy here. And if you want to be an investor in real estate, you have to have income. 2 years of a W-2 pay stub, essentially, or if you're self-employed, the same exact thing does apply. If you are somebody coming straight out of college with, say, a 4-year degree in computer science or whatever else it is, if you get a job in that field, you will automatically qualify at your salary income as if you already worked at a job doing what you went to school for 2 years. So that's the basics right there. You need to have income, just like you do for any other loan. Now, you're gonna need some money for a down payment for a loan, but this is the key. I cannot stress this enough. If I were to want to buy a rental property and live in the same house that I'm living in, just buy a property outright, you need 20% down, even to buy that rental property. So if you wanted to buy a $100,000 rental property, you're going to have to put up $20,000 just for the loan and add on top of that your closing costs, which can be in between 1 and 3% of the total cost of the house. So putting it in that perspective, real estate seems like it's out of reach. But here's the key. You can buy one house, move into that house for 3 to 5% down every single year. So in other words, what I have been doing is bought a house, lived in it for a year, saved up enough money for 3 to 5% down on the next house, bought that next house, and rented out the house that I had essentially just lived in. So that is the real key, and that's where the money is actually made. And the reason why you want to own real estate, to grow your net worth, to open up tons of opportunity and possibilities for you, is because of leverage. If you can pay 3 to 5% of a property's value and get the keys to that, one, your rental income should give you profits every month. It should bring in more than what the mortgage, taxes, insurance, all of that will cost you. But I know somebody out there is watching this video and thinking, tenants and toilets, I'm going to be bothered every minute of my life at late hours of the night. That's not the case. And we're going to talk about how to avoid that exact situation, because nobody wants to deal with that, and that is not worth your time. And you don't have to if you follow these sound investment principles. But let's talk about leverage a little bit more. And what I mean by that is the average home goes up in value in between 3.5% and 3.8% per year. So essentially, in 1 year, you could be or should be at least positive on your equity gain, right? If you put 3% down on a $100,000 house, you should at least make 3% that following year, essentially make your $3,000 back in home equity. And when you add in the fact that somebody else is paying the mortgage for you by living in your property, you're renting your property out, you're making monthly passive income. So you're already making a profit. So that equity gain is the icing on top, and that's the whole reason to be investing in real estate to begin with. Now, how do you avoid bad properties? What kind of properties do you want to buy? Well, you want to buy the houses that don't look so pretty, but have solid foundations, a good roof, good plumbing, good electrical, and that all comes into your inspections. I'm going to give you guys really, what you should look for when it comes to inspections, but always make sure to hire professionals. If there's a problem, investigate it a little bit more if it makes sense to do so, and if you think you're getting a good deal. So generally speaking, you want to get the nasty properties that might smell, bad carpet, you got to replace that, you got to paint the walls, you got to redo the cabinets. That's where the money comes in, because again, generally speaking, those properties are marked under market value. 2021 was a little bit different. 2022 is likely to be a little bit different as well, in the sense of you will see properties that agents are listing. By the way, I am a licensed real estate agent, so you'll see properties that need a ton of work that are still listed at market value for that neighborhood. That's where you have to be savvy, and you have to say, hey, I'm going to need to replace the carpets, paint the walls. I'm going to have to do all of this stuff right off the bat when you submit your offer and submit a lower offer. Never, ever, ever just say, hey, you want $150,000, it needs $10,000 worth of work, I'll give you $150,000. Never, ever do that. Trust me, there's always room to negotiate when you're talking about real estate. Now, the houses you want to avoid like the plague are going to be your flips, because 9 times out of 10, you're not getting the most qualified contractors, or sometimes they're not even contractors at all, that are flipping these houses. Sometimes they even do unlicensed, illegal work. And take it from me, my first house I bought when I was 19 years old, I had no idea what I was doing. I was not a real estate investor. I invested in stocks, but I didn't know nothing about real estate, right? In my case, the main sewer line was cracked, and my basement would flood every 6 months or so, and that's about a $30,000 repair. So take it from me, always get your main drain line inspected, no matter what house it is, no matter if it's a crap house or a nice house. Get that inspected, your roof, your electrical, and all that. But if you start to see red flags on a house that looks really good, that's visually appealing, that's something to take into consideration, that even one thing like that, that's $30,000, can flip your whole investment upside down very, very fast. So generally speaking, I will not buy a flip. Feel free to if you guys want to. It's definitely taking on a little bit more risk, and you don't want the risk. You just want to make money. So that's really the house that you should avoid like the plague. And at the same time, those flips are usually marked over market value. So they're already trying to get a lot of money to begin with. And that's basically all I have to say on that. Avoid the flips at all costs. I should also mention that not all states or even markets are created the same. Something like California, you might actually lose money per month on the rental income you get. You could actually have to pay out an additional couple $100s per month, but you're in an area that is growing rapidly and say making you 10% per year. On a $500,000 house, that's $50,000 of equity gain per year. If you're losing $200 or $300 a month on actual cash flow, it can make sense to even pay full price for that house if it has a proven record of growth and is likely to continue into the future. Take for an example, like my home state though, of Michigan, you have more cash flow than appreciation. Your appreciation values are usually in between 3 and 4%, on par with the national average, but your cash flow per month can be sometimes 50 or 100% of the mortgage. Say you bought a house, a $100,000 house for a $600 a month payment. You could turn around and rent that house out for $1,200 per month, but your equity value is not going to go up as much. So in that case, you do want to make sure you get at least a below market deal. Now to, in my opinion, one of the most important things, if not the most important thing, when you are renting out your property, and that is screening tenants, making sure that they can actually make their payments, they have good credit, or whatever else you want to follow. Generally speaking, I'm not going to let anybody rent a house from me unless they could buy their own house, which does mean you're going to get people that are likely to live there a couple years and then buy a house on their own. And that's what you want, because you want somebody with good credit that is able to make their car payments, preferably no student loans, things like that. More trustworthy candidates. If somebody has a bad credit score, you run their credit. Make sure you do that, or just get a property manager like I do. You run their credit and you see a bunch of missed payments. It's terrible. Never rent to them, because they're going to be the ones that are spiteful, that is essentially going to take a sledgehammer to your walls when you evict them out. So do not do that under any circumstances. I don't care what sob story they give you. You are running a business and you have no time to lose money, or this equation does not work. Also, make sure that you verify their employment, not by calling, the number on their application. Go in if you have to. Try to meet them. Do what you have to do, especially when you're starting off and you do essentially need those first properties to work out. Make sure you verify that by any means necessary. I don't care if you have to go be a social media warrior, whatever you got to do. But make sure you can verify that they've at least had a job for 2 years. If they have not, and there's somebody that goes job to job to job, do not rent to them. Don't charge them a premium to rent from you. Don't do it. You're going to end up costing yourself more money and more headaches than it's actually worth. And preferably, I want to see somebody that's been at the same job 3, 4, 5 years. If you can get those kind of candidates, you can sleep better at night. And statistically speaking, they're going to pay you more consistently. They're not going to try to pull excuses because they just quit their job and they're trying to find a new job. Things like that. This next part is also very important, especially if you are not using a property manager and you are managing your properties yourself by showing the properties to potential tenants. You're doing all of that stuff. You're actually communicating with the tenants. I like to use property managers so I could just have it an automated system. If they have a problem, the tenants, they call the property manager. They don't call me. I don't ever have to know the tenants directly. If you are not doing that though, don't tell them you are the owner of the property. You legally do not have to. Tell them that you're an investor in the property. There's other investors in the property. So when they say, "Hey, I'm late this month on rent, I'll get it to you, midway through the month." Maybe let that slide the first time and then say, "Hey, the first time's okay, but the investors on the property, they are letting you do this once. The next time it happens, you'll be charged that late fee." You want to have some leeway with them, but you want to make it very stern that whatever they're used to dealing with their other, house they used to live in with their other landlord, that you're not going to let that fly and you're going to charge late payments, and that you will also evict them if they don't follow the rules. That's very important. If they know that you're the owner, they may try to pull your heartstrings per se and try to get over on you. And when there's investors involved, they're not going to do that as much. And quite honestly, they're going to think, "Hey, if I try to destroy this property or do something like that, I'm going to get sued because there's investors that want their money." Remember, use this to your advantage. Investors, in a lot of people's eyes, are sharks. They're bad people. They do a lot of bad things to get to where they are, which we know that's not the case. If you're watching this video, you're likely an investor, and the best way to invest your money is honestly and to be fair. So these are all the basics of what you really have to know if you're looking to invest in real estate in general, but hopefully the bank hack method of buying a house for 3 to 5% and then living in that for a year and doing the same thing over and over again, while every house you're moving out of, you turn that into a rental. Hopefully that will serve you guys well, as it has done for me. As long as you follow these sound investment principles, you will do just fine. And by your 3rd, 4th, 5th house, your cash flows as well as your appreciation values per year is going to start ballooning in a rapid pace. So in the course of 20 years, you could easily have 15 to 20 rental properties, and that's well enough to either sell outright, invest in dividend stocks, do whatever you want to do to retire, or just have a lot of extra money per month. So after all, if you guys did make it to the end of this video, or if you learned something, hit the like button for me and subscribe to the channel. We are just getting started as far as strategies in investing in the stock market, trading, real estate, the whole bit. So do that for me. Thank you guys. Appreciate you. I'll see you in the next one.